Hi, I'm Marc Cunningham, the president of Grace Management. We've worked with thousands of real estate investors since 1978. The one biggest point of commonality in success, financial success for our investors, has been paid for real estate. Now I understand you can use debt, you can use leverage to amplify your returns, and that's fine. But once you get the debt paid for, get the debt removed, and you have paid for real estate, it's going to allow your income to really skyrocket. That's what you want really as a long-term investor. Let me show you an example. This is a picture of a recent property I purchased. It was brand new construction. That's why they have a schematic of the property. Brand new construction. I was excited to get it. I think it's going to be a great long-term rental for a short-term rental, long-term investment property for me. So here's the numbers on this property. I have a loan on this property of $200,000. I borrowed $200,000 from the bank. My interest rate is 4.375%. It's on a 30-year mortgage. It's a floating rate, so that interest rate's going to change after about 10 years. So my PI, my principal and interest payment every month to the bank, $999. That's what I have to pay to the bank to borrow the money. Now keep in mind, this doesn't include insurance, doesn't include HOA or taxes. It's just my principal and interest, $999. Here's a screenshot of an amortization table, right? At closing, you get an amortization table to show you exactly every month how much of the money you pay to the bank applies to principal, how much goes to the interest, and think of interest as a penalty. Interest is the penalty you are paying to the bank for the right to borrow the money. So in month one, my payment's $999. I'm paying principal, my principal to pay down, $269. My interest or my penalty to borrow that money, $729. My balance after month one, I paid $1,000 to the bank. My balance went from $200,000 to $199,730. Didn't do much. I just paid $1,000. My balance only came down by $269. Now, if I pay this out over 30 years, just make my regular payment every single month, I'm going to pay to the bank $159,485. That's the penalty in essence I'm paying to the bank for that right to borrow the money. That's a lot of money. The reason this money is so high is because of this concept, compound interest. Banks understand this. Finance people understand this. Compound interest is what makes that number so high on a seemingly small interest rate of 4.375%. Albert Einstein called compound interest the ninth wonder of the world because it really does work in an amazing, amazing way. So think of it this way. After month one, again, my balance is $199,730. If somehow in month one I could come up with a payment, I could reach under my couch cushions, I could go earn a little bit extra money, I could mow lawns, deliver pizzas, whatever it took, but I could come up with $1,100. So month one I go to the bank, I give them my first monthly payment of $1,000, but I also give them $1,100 and I ask them to apply it to the principal of my loan. Let's go back to our amortization table. Here's what I just did, okay? Here's what I did. I basically leapfrogged over 5 months worth of payments by taking that $1,100 payment. You say, well, Mark, I don't even understand. How does that work? Well, what I did is I'm paying the principal every month until my $1,100 gets used up. So I've got $1,100. Well, in month one, I'm paying $269 in interest. In month two, $270, $271, $273. So I've jumped over all those payments. Those are payments I will not have to make. Now, don't misunderstand. You'll still need to make your payment in month two, in month three, in month four, but I've cut these payments off the back end of my mortgage. I've just shortened my mortgage by 5 months on the back end by paying $1,100 today. That's the power of compound interest. Here's another good way to think of compound interest. Reach in my pocket here. Here's a $1 bill. Okay, so compound interest means every night when you go to bed, you take a $1 bill, and you're going to send this dollar bill to work for you. We'll call him Bill. So Bill's going to go to work for you. So imagine that you give Bill a little briefcase as you're getting in bed. You scurry him off. Bill runs off, and you don't see Bill till the next morning. And the next morning, as you wake up revived and refreshed, Bill comes back into your bedroom, and Bill's got with him a penny. He brought back with him a penny. That's how much Bill earned, and Bill's looking tired. He's a little bit raggedy. He's beat up. He worked hard all night. What did you do all night? You slept. Compound interest is your money working for you, going out every day and coming back with a little bit more. And over time, this adds up to big big numbers. That's what compound interest does. That's what it looks like for you as a real estate investor to put your money to work for you. You want to do that. So let's go back to our example. Let's say that somehow you're able in this scenario to come up with an extra $100 a month. If you had to, you could squeeze $100 out of your budget. So if you could come up with $100 a month, if I could come up with $100 a month on this loan, every month I would cut 5 years off my payments. 5 years. I turn my 30-year mortgage into a 25-year mortgage. Now, if you're just starting off, you're thinking, well, 25, 30 years, it's so far down the road that I can't even comprehend that. I get that. But if I told you today that for the next 5 years, you didn't have to make a mortgage payment, would that impact you financially? You bet it would. It would save me $30,000 in interest. So much my savings would be simply by paying $100 a month. And remember that $100 a month, it's going to come back to you eventually when you sell the property or pull money out, but it's saving me $30,000. Just for fun, what do you think it would be if I could come up with $200 a month? How much time would I save? What do you think? What do you guess? 8.5 years. 8.5 years I'd cut off my mortgage and I'd save over $50,000 in interest. That's compound interest. So here's how you need to think of this. Think of the concept, this is another finance concept, opportunity cost. Opportunity cost is a financial term which means when you spend $1 on anything, the opportunity cost is everything else you can't spend that dollar on. If I take this dollar bill and I go to the store and I buy a candy bar for $1, the opportunity cost is everything else I could have done with that bill. Now you can't do much with $1, so let's pretend it was $100. If I go spend $100 at a restaurant, the opportunity cost is the pair of shoes I could have bought. The opportunity cost is the extra gas I could have put in my car. The opportunity cost is anything else that you're giving up by doing that. So going back to our amortization table, the first thing you want to do is print this amortization table out for yourself, either for your house or for your investment property. You need to have this in front of you so you know every single month how much is going to principal. And what that means is the opportunity cost of $269 to me this next month is one future mortgage payment. Because if I could somehow pay $269 now, I'm able to leapfrog over that mortgage payment. Print this out. Think in those terms of opportunity cost, of mortgage payments. Strive for this. You've got to get it in front of you. You've got to keep it at the forefront of your mind. And the best way to do that is to print on paper an amortization schedule of your loan. You can go online and print those out. We'll have a link in the part of this video. If you look at the verbiage part, there'll be a link there to where you can go in, print out an amortization table. You've got to do that. It's valuable and it will help you achieve financial success.